The American dream of home ownership is dead for 75% of Americans, and what's replacing it will shock you. Major home builders are abandoning traditional home sales entirely. Warren Buffett just deployed nearly $1 billion betting on this shift. And there's a reason millionaire renters have tripled in just 4 years. Look, we need to show you something that nobody's talking about. According to Harvard's Joint Center for Housing Studies, you now need $126,700 in annual income to afford the median home in America. But here's what the data reveals. The typical household only makes $80,610. That's a $46,000 gap that's mathematically impossible to bridge for most families. And before we show you which 3 markets are about to see the biggest disruptions, let me explain why even people who can afford homes are choosing not to buy them. Have you noticed this in your area? Empty new construction sitting unsold while rental communities fill up instantly? But here's what's really happening that changes everything. Let me tell you exactly what I discovered when I dug into the latest data from the National Association of Realtors and RealPage's Q1 2025 reports. Housing starts just crashed 24.1% year over year to 1.3 million units in June. But here's the kicker. Build-to-rent construction is exploding, now representing 7.9% of all new single-family construction. That's 110,000 rental units currently under construction, a 53.5% increase. Think about that for a second. Here are the 3 markets showing the most dramatic shifts, and if you're investing in any of these areas, you need to pay attention. Texas leads with 22,000 build-to-rent projects in development. Arizona follows with 14,000, and Florida? Well, I'll get to Florida's situation in a moment, because what's happening there is creating opportunities most investors are completely missing. But wait, let me back up and tell you what triggered all of this. The median home price hit $422,400, while mortgage rates stuck at 6.58 to 6.72%. Do the math with me here. That's a monthly payment of $2,800 to $3,100, including taxes and insurance. According to standard lending requirements, you need that $126,700 annual income that I mentioned. The price-to-income ratio is now 5 times the median household income. Historically, 3 times was considered the healthy limit. We're in uncharted territory. Have you tried to buy a home recently? What did your lender tell you about income requirements? Here's what the mainstream media isn't telling you about the rental market. Everyone's screaming about 50% increases in rental applications and bidding wars, right? Wrong. That's only happening in Manhattan, where 24% of leases involved bidding wars, and Miami with 21 applicants per vacant unit. The national apartment vacancy rate actually hit 7.1%, the highest since 2017. The average rental takes 28 days to lease now, up from previous years. Austin rents have crashed 6.8% year over year, down 18% from their 2022 peak. But before we show you why luxury rentals above $5,000 monthly are exploding, let me address the elephant in the room. Warren Buffett's Berkshire Hathaway just deployed $800 million into Lennar and $191 million into D.R. Horton in the first half of 2025. These weren't random picks. SEC filings from August revealed these were the mystery stocks Berkshire had been hiding. Now, Buffett himself probably didn't make these trades. The size suggests portfolio managers Todd Combs or Ted Weschler. But here's why this matters to you. These builders aren't just building homes anymore. Taylor Morrison launched Yardly, their build-to-rent brand, with nearly 3 dozen projects across Phoenix. I'll try that again. With nearly 3 dozen projects across Phoenix, Dallas, Austin, Houston, and Orlando. Backed by an $850 million joint venture with Varde Properties. Lennar's offering sales incentives averaging 13% of final price while massively expanding rental operations. And this is really wild about who's renting now. Millionaire renters tripled between 2019 and 2023, from 4,500 to 13,700 households nationally, according to Rent Cafe data. Houston saw a 25-fold increase. Miami, Dallas, Atlanta, similar explosions in high-income renters. These aren't people who can't afford to buy. They're choosing flexibility, avoiding illiquid real estate, while deploying capital in higher return investments. Let me show you the 3 cities where this trend is most extreme and why it matters for your investment strategy. Miami leads with a 96.7 rental competitiveness index, 22 points above average. Manhattan's median rent hit $4,300. Brooklyn's seeing 31% of leases with bidding wars, some pushing rents 20% above asking. Boston, units getting over 20 applications with 15% of apartment bids above list by an average $177 monthly. But here's what investors are missing about the flip side of this coin. Austin's down nearly 20% from peak. Atlanta's offering up to 10 weeks free rent with 19,300 units waiting for tenants, and another 27,553 under construction. Phoenix, Denver, other Sunbelt markets that boomed during the pandemic, massive concessions. Texas landlords averaging over 6 weeks of free rent. Have you seen these concessions in your market? Are landlords getting desperate where you are? Now let me tell you about the hidden costs that are making ownership even more impossible. Homeowners insurance premiums skyrocketed 24% over 3 years, according to the Consumer Federation of America. Treasury Department data shows 54% of owners reported increases just in the past year. Louisiana facing 28% annual increases. California seeing 21% jumps. That's another $500 to $1,000 annually on top of everything else. But here's the data point that should terrify every potential buyer. Construction costs keep rising 5 to 7% annually. The industry needs 450,000 new workers annually, according to industry reports. Material costs remain volatile. The Federal Reserve kept rates at 4.25 to 4.5% through July 2025, with mortgage rates stuck between 6.5% and 7%. Even if the Fed cuts, mortgage rates won't drop significantly until 2026 at the earliest. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Let me break down exactly what smart investors are doing right now. First, they're following the institutional money. Despite fears of Wall Street buying everything, institutional investors owning 1,000 plus homes control less than 1% of the total U.S. single-family housing. But look where they're concentrated. Atlanta, with 11,144 Blackstone-owned homes, Dallas with 5,172, Charlotte with 4,710, Tampa with 3,949, and Phoenix with 3,801. But before you rush into these markets, here's what the latest data from CoreLogic reveals. Small investors with 3 to 10 properties still dominate, accounting for 60% of investor purchases. Mom-and-pop landlords are quietly reshaping the market. States like Georgia and California see investor shares reaching 34 to 35% when you include these small players. Now, here's the controversial part that nobody wants to admit. The traditional path to home ownership is mathematically dead for most Americans. First-time buyers face a $30,800 annual income shortfall, according to NAR data. The West region's median home price of $620,700? Forget it. Even the affordable Midwest at $333,800 requires incomes well above local medians. So what should you actually do if you're trying to buy? Here's our advice based on the data. Geographic arbitrage is your only option. Target Midwest markets where that $333,800 median means you only need about $100,000 household income. Look at condominiums averaging $362,600 nationally versus $428,500 for single-family homes. That reduces required income by roughly $20,000 annually. But here's what most people don't realize about state programs. State first-time buyer programs offer down payment assistance, but they have income limits and purchase price caps that restrict options. FHA loans help, but you're still facing that massive monthly payment. The 8 to 9% down payment averaging $36,000 nationally, that's years of savings for most families. Have you looked into these programs in your state? What did you find? Now let me address what's really happening with inventory, because this impacts everything. Housing inventory improved to 4.6 months of supply in July 2025, up from pandemic lows, but still below the 6 months indicating a balanced market. 9 states exceed pre-pandemic inventory levels, Texas, Tennessee, Florida leading. But June 2025 completions plummeted 24.1% year over year. We're heading for another supply crunch, but not where you think. Here's what builders are actually doing with that $40 billion in institutional investment. The build-to-rent pipeline includes Phoenix's Avondale-Goodyear submarket, with 4,568 units underway, the highest concentration nationally. These professionally managed communities command 10 to 15% premiums over traditional rentals. Smart home technology, co-working spaces, maintenance-free living. They're not competing with apartments, they're replacing home ownership. But here's the trend that changes everything for 2025 and beyond. 20% of remote workers plan relocations in 2025, according to Howdy's research. The donut effect continues. 58% of big city leavers stay within the same metro but move to the suburbs. This intensifies suburban competition while softening urban cores. Let me tell you exactly which markets benefit from this shift. Nashville, despite moderate competition now, sits perfectly positioned. Redfin shows homes there selling in 20 days on average. The infrastructure is ready for remote workers. Same with Raleigh, Richmond, smaller Texas metros outside the major cities. But here's what the National Association of Homebuilders data reveals that should concern everyone. Nearly 60% of U.S. households can't afford a $300,000 home. Think about that. $300,000 is below the median in most markets. Builders continue developing homes averaging $458,826 for new construction, affordable to just 25% of households. They know exactly what they're doing, building for the wealthy while creating rentals for everyone else. So here's our bottom line after analyzing all this data. The housing market isn't broken. It's been restructured. We're witnessing the creation of a permanent renter class, not by accident, but by design. Builders pivot to rentals because that's where the demand is. Institutions invest in rentals because that's where the returns are. Even millionaires choose renting because that's where the flexibility is. What does this mean for you as an investor? 3 things. First, stop thinking about single-family rentals as a temporary investment. This is the new permanent reality. Second, focus on markets with job growth, but housing supply constraints. Not the obvious expensive coastal cities, but secondary metros attracting remote workers. Third, if you're trying to buy a home to live in, accept that you might need to rent longer while building income, not just saving for a down payment. Have you adjusted your investment strategy based on these shifts, or are you still waiting for prices to drop? Look, we've been tracking real estate data for years, and we've never seen a structural shift this dramatic. The Fed might cut rates, prices might stabilize, but the fundamental math won't change. When 75% of Americans can't afford the median home, when builders abandon for-sale development, when even the wealthy choose renting, that's not a market cycle, that's a transformation. The American dream hasn't just gotten harder, it's been replaced. And the sooner you accept that and adjust your strategy accordingly, the better positioned you'll be for what comes next. If you found this video interesting, please subscribe, share, and watch this one as well.